Hi there, welcome to Kneppyinvests. I wasn't planning on doing a video on the company I'll be featuring this video, AI Media, but even though this company was on my watch list, I wasn't really thinking or planning on buying into the company because the share price was around $1 and I thought that was probably fair value, even though this company is growing at a fairly good rate. I just decided just to leave it on my watch list just to see how the company performs financially over the next 1 year, because they've only been on the ASX for about a year. We only have 4 quarters of history and they have grown through that period. But all of a sudden, on I think it was Monday the 15th of November, we saw the share price drop 20% in the 1 day on massive volume. No reason why on the day, because the company had released no news flow. But then on the 16th of November, the company released details about a research report that Morgans Financial had put out there. And Morgans Financial actually had a downgrade for AI Media. And that's why the share price had fallen 20% on the previous day and then fell another 10% on the Tuesday, 16th of November. And with the share price down 30% from $1, I decided to take a position in this company because at 70 cents, I definitely can see value. And these are sort of situations where you can take advantage of fear, because fear is the most powerful emotion when it comes to investors. When there is a slight increase in risk, you will see shareholders sell out no matter what. The slightest bit of fear or increase in fear, and they will run for the hills. And that's exactly what happened with AI Media. Even though this downgrade wasn't an official downgrade, because AI Media have no financial year 22 guidance out there. They did do a sort of rebuttal against this report, reasons why this downgrade in guidance from Morgan Financial might be a little bit far out there, but I did see an opportunity to take a position in this company because these are the sort of opportunities I am looking for all the time. Now, whenever I see an official downgrade from a company, that's not the time to buy in. But when you see a share price decreasing by 30% because of fear, and most of the time it's unjustified fear because of these sort of releases. For instance, Hansen Technologies, I bought into them after takeover bid failed, and the share price of Hansen Technologies now has rallied to be above the takeover price. And those are the sort of situations I am looking for. Now, it doesn't mean AI Media share price will go back up to $1 quickly, because we have seen now, because of this research report, an increase in negative sentiment behind the company. But massive spike in volume. This is now becoming, this company is now on the radar of value plays, because when you look at the growth in the company, particularly the revenue, it has been growing substantially over the last few years. And a lot of that is because of acquisitions, but a lot of that is organic growth. And I just see an opportunity to buy into a company that looks like it will be coming consistently operational cash flow positive quarter on quarter. And that's very attractive to me, with a company on a market cap of about $140 million and about $20 million of cash as well. In this video, what I'm going to do is talk about AI Media's September quarter, Appendix 4C, look at the previous June quarter, and then go back a year, look at some of their cash receipts history, only 4 quarters of history. And then I'll just talk about this research report and AI Media's response. So let's get stuck into it and talk about what actually AI Media does. AI Media is a captioning, transcription, and translation services company. For instance, some of their services include live captioning, recorded content, smart automatic speech recognition, video and audio transcription, translation, and captioning for Zoom meetings. This company was founded in 2003 by Tony Abrahams and Alex Jones. Alex Jones was born deaf, and it seems like he's really passionate about accessibility to information for people with disabilities. And that really is a nutshell about what AI Media is doing. Seems like also Tony Abrahams, the other co-founder, is really passionate about that as well. Tony Abrahams is the CEO and co-founder, and this company listed on the ASX on the 15th of September 2020, so that's about 14 months as a listed company. It was actually under a different name, something like Access Innovation Holdings or something like that, and then they changed the name to AI Media. I think it was in June of this year, and Tony Abrahams, 13.3% holding in this company. A non-executive director and the chair of the company, Deanne Weir, has a 9% holding. So together, both of these insiders have over 22% holding. So there's a fair bit of skin in the game, and that is something I definitely look for. Two other largest shareholders in this company are Regal Funds and WH Soul Pattinson, with 4.7% and 3.4% stake, respectively. Now, the market cap right now at 69 cents is 145 million. At about $1, the market cap was over $200 million. And this is that definite opportunity I'm always looking for when you see the valuation of a company come back because of an increase in fear. So I did buy in at 70 cents on the 16th of November, and the ticker for this company is AIM. Before we have a look at some of this company's Appendix 4Cs, in fact, we're going to look at three of their quarterly reports, so one from 1 year ago. We'll look at the June quarter report, which initially got me interested in this company, and then the most recent quarterly report. So let's have a look at their financial performance over the full financial year 21. Just compare it to financial year 20. Revenue has increased considerably from 25.4 million to 48.7 million. Some of that is because of acquisitions, but the majority of that increase in revenue is organic growth. That's very important. Gross margins have increased from 39% to 42%. And when you look at operating cash flow and profit, that might be a turnoff for a lot of people. Operating cash flow for financial year 21, negative 18 million, and unprofitable or loss-making by $11 million. But when you look at the last two Appendix 4Cs, they have turned around the operating cash flow to be positive. If you take both the last two Appendix 4Cs combined, this company has been operational cash flow positive over the past 6 months. They have had $18 million of cash on hand at the end of the financial year 21. Now, they are transitioning to SaaS revenue or SaaS for some of their services. And one of the reasons and good reasons behind doing that is because SaaS revenue have the highest margins, 75% margins compared to services margins of 40% and hardware margins of 70%. And that's why a lot of investors are attracted to those sort of companies that are SaaS software companies. And at this point in time, in the last quarter, 16% of their revenue was SaaS derived. That seems like it is increasing at a pretty good rate. And the price-sales ratio, with this decrease in share price, is only 3 right now, and that's very attractive as well. So not too hot in terms of price-to-sales ratio. So at this point in time, a lot of things going right for this company. And only one thing going wrong, and that was this negative report from Morgan Financial. Let's go back 1 year to look at how this company was performing in September, the September quarter of 2020. Around the time they did list on the ASX, receipts at customers $9 million, and they were burning through a fair bit of cash because product manufacturing and operating costs, 7.2 million, staff costs, 3.5 million, and administration costs, 800,000. That meant the company was operational cash flow positive by 3.2 million. However, they did do a capital raising, or the IPO, which raised $37.3 million. That increased the cash on hand to $27.7 million. And they also repaid a bit of debt, $3.5 million. So not much debt, if any at all, for this company right now. And that's one of the reasons they did IPO, is to repay the debt, but also to increase the cash on hand to make some acquisitions. They made about 3 or 4 acquisitions in the past year. And even though those acquisitions haven't increased the revenue by as much as the organic growth, I think over the next few years, a lot of these acquisitions will help this business increase the revenue quite substantially. And that's always a good thing. Well, mostly a good thing, because potentially the margins could decrease. Potentially the acquisitions won't work. That's always the possibility. But I think companies at this stage in their development, on the most part, acquisitions are helpful to the overall success of a business. Now to the quarter report that really piqued my interest in this company. I really hadn't done much research in AI media. I really hadn't thought about this company until I saw the June quarter results. Receipts to customers up to 17.9 million, which was a fair increase from the previous quarter. And because costs weren't increasing at a greater rate than receipts growth, that meant the company was operational cash flow positive for the June quarter by $5 million. And whenever I see a company that is operational cash flow positive in one quarter by $5 million, I'm always going to have an interest in that company. So that's when I started to do a little bit more research on AI media. Now, there's a bit of a discrepancy between the year-to-date numbers in the cash flow report we see here compared to the full-year report that they did release in August. For instance, in the financial year report they released in August, it states that the company was operational cash flow negative by about $17 million, but here it's stated as only $3.3 million. That's a big discrepancy between the two reports. I'm going to have to try to understand why there is that discrepancy. Now onto the cash on hand. Now, the company did do an acquisition. I've already mentioned they've made 3 or 4 acquisitions in the past year, and they spent $28.7 million on those acquisitions. They also did another capital raising $40 million. And because the capital raising was more than the acquisition, they grew cash on hand from $4.4 million to $17.8 million. On to the most recent quarter report from AI Media. This was, or would have been released in October, towards the end of October. This is the first quarter of the financial year 22 year. Receipts to customers was down from the previous quarter to 15.3 million, and they had increased some of their costs. For instance, product manufacturing and operating costs increased by 2 million, staffing costs increased by 200,000. Because costs increased, cash receipts came down. AI Media was only operational cash flow negative by $25,000. We'll call that operational cash flow neutral because it's so low, it's almost zero. Won't say that's negative or positive, it's definitely neutral. They did spend a little bit of money on acquisitions, $1.6 million on another acquisition. That meant the cash on hand in the business fell from 17.8 million to 15.5 million. So if we go back to the June quarter, when I see a company that is operational cash flow positive by $5 million, I don't take action on that really good report straight away. I just want to wait to see how the company does perform on the next few quarters. And this is a good quarter from AI Media. It's not as good as the previous quarter, but they aren't operational cash flow negative by a large amount. And because receipts from customers can be quite lumpy, they can go down and up, there is a possibility the next few quarters will be quite good for this company. So that's why at $1, I was just having this company on my watch list, just waiting for an opportunity to buy in. And I got that opportunity when the share price fell 30% to 70 cents. Because AI Media listed on the ASX in September of 2020, we only have 5 quarters of receipts history here. And I do prefer at least 8 quarters to determine a trend, but it is quite obvious that with only 5 quarters, there is a trend developing with this company, and that trend is up. Some of this is because of acquisitions, but a lot of this trend up is because of organic growth. Beginning in the first quarter, September quarter 2020, $9 million, and that's increased to $15.3 million in the latest quarter. And you can see the trend is not in a straight line. You do have this lumpiness, and on occasion you will see receipts come down in one quarter. That doesn't mean receipts are falling, because you never know, in the next quarter, the December quarter of 2021, we might see receipts go up to maybe 20 million. Who knows? And that will just confirm that the trend in receipts is going up. So at this point in time, it's looking good. Even though we only have 5 quarters of history, it is looking fairly promising for AI Media. There was a fair bit of hype around AI Media when they did list on the ASX, and that hype didn't last very long. In fact, it lasted less than 1 day, because the share price high for this company was on the first day of listing. In fact, the share price went as high as almost $1.50 and then fell through the day to about $1.27. And then the share price just kept on falling. In fact, it fell from about that $1.50 to $1.30 range all the way to a low of about 70 cents, which was reached in March of this year. So the market was not that interested in this company. Not a lot of volume. Highest volume was in the first few days of trading. But it did look like the share price and the sentiment had turned around for AI Media from that low of 70 cents in March. And the one negative thing about AI Media and that trend up, or the potential new trend up, was just the lack of volume. Not a lot of volume. The share price was rising fairly consistently, a little bit of volatility, but that's exactly what you would expect. In fact, the share price at one point towards the end of October reached about $1.15. But then on the 15th of November, the share price, for inexplicable reasons, for those who are looking at it, fell from about $1 all the way to 77.5 cents, a decrease of 20% on massive volume as well. And that was a telltale sign that there was something happening behind the scenes with this company. And then they released, AI Media released an announcement to the market on the 16th in regard to that research report, and actually did give a response to that release. And even though they did give that release, the share price fell another 10% on even larger volume. And I think the reason it fell by 10% on that day was a lot of people the previous day didn't know what was happening. And as soon as they saw that Morgan Financial had downgraded their forecast for the company, that little bit increase in fear just meant they were going to sell out, because a lot of investors just don't like uncertainty. And uncertainty will drive shareholders out of positions, even though it looks much cheaper, this company, at 70 cents than it did at $1. I started trading on the 17th of November, even though I'm doing this video only 90 minutes after trading has begun. The share price looks like it is leveling off. A little bit of an increase in volume from what we've seen throughout its history on the ASX, but definitely lower volume in the last 2 days. But we don't know. There could be an increase in trading over the rest of the day. We just don't know that at this point in time. But it does look promising. The share price is holding around 70 cents. And I think potentially there are some value players out there looking at the share price at 70 cents and thinking this is a good buy, a much lower risk buy than it was at $1. And now I'm in that camp at this point in time. But I'm very mindful that there is a reason why Morgan's Financial did have a downgrade compared to what they were forecasting for this company. And that downgrade actually came just after AI Media's AGM. So Morgan Financial, or whoever did that report, saw something in the AGM that they didn't like, and that's why more than likely they did that downgrade. Or there could be some nefarious reasons why they did it, but I won't talk about that because more than likely that's not the reason. I just want to talk about the Morgan Financial research report, and then also talk about AI Media's response to this report. Now, this report was released on November 12, which would have been the Friday. So possibly it was released after the end of trading, because the share price decrease happened on the 15th of November on the Monday. Maybe the members of Morgan Financial had time to digest the report over the weekend. Anyway, it was a downgrade from where Morgan Financial had, or the numbers Morgan Financial had released in their previous report. For instance, they revised revenue down from 70 million to 61.6 million, and revised EBITDA down from 9.6 million to 0.6 million. This was a substantial downgrade from Morgan Financial. And if the company itself, AI Media, had released this sort of downgrade themselves, we would have seen a share price take a massive hit. But as AI Media did mention in their rebuttal, their reply, the company has not released any earnings upgrade or any earnings guidance for financial 22, because they say it's just too early at this stage to say how they are performing and will perform for the rest of a financial year. And that's a very reasonable thing to say, because even though a lot of companies do put out guidance, I think at times it is very unfair on management to release guidance, because we just don't know what's going to happen over the next 9 months. Some companies do know how they're performing, but those are the sort of mature companies that are going to be within a range over a financial year. Companies like this, AI Media, that are growing rapidly, you just don't know. Management just don't know exactly how they're going to perform. One thing I do like management doing is to put out very conservative forecast or guidance. I do like management teams who overperform their guidance. And those sort of management teams I am very attracted to. I hate the complete opposite. Those sort of management teams who think they're going to do wonderful well and then underperform their guidance. And you usually see those companies underperform in regards to the share price compared to those other companies. The company AI Media also said they wouldn't necessarily respond to a research report, but they mentioned that this research report did have a negative impact on the share price on the 15th of November, and that's the day the share price fell 20% on massive volume. So they decided they should respond to that report to ensure an informed market. So let's have a look at how AI Media did respond to that report. The first thing AI Media mentioned is they are targeting positive operating cash flow in financial 22 and beyond. And that's absolutely reasonable because they've already achieved that on a quarter-by-quarter basis in the last quarter of financial year 21. And even though they were slightly operational cash flow negative in the first quarter of this financial year, it's only by $25,000. So definitely reasonable that they will be able to become operational cash flow positive on a consistent basis from here on in. They also mentioned they're accelerating their strategy into SaaS simply because it is higher margin. And if they are successful in transitioning their services to SaaS, there is a potential that these companies will become even more successful, more operational cash flow positive because of those higher margins. They also mentioned that there's significant greenfield growth markets, or the significant greenfield growth markets are emerging faster than anticipated. I think they mentioned India in that section of their reply. And that's always a good thing when something is growing faster than you're anticipating. So I'm not sure at this point in time, because I have not read Morgan Financial's report, why they are so bearish, what they saw in the AGM that turned them from being bulls to bears. I would be interested to see what they saw in that AGM. I saw nothing. So I did have a look at AI Media's AGM. There was nothing really that stood out that would definitely show why anyone would be so bearish like Morgan Financial were. Maybe Morgan Financial talked to some of the management team of AI Media. Maybe there was a change in analysis. Maybe the new person doing the AI Media analysis was a little bit more bearish. It could be something as simple as that. But I would like to know why they have become bears in this company. And that's all I have for this video on AI Media. Hope you have enjoyed it. Hope you've understood why the share price of this company was down 30% over 2 trading days. And if you do have any questions about this company or any other company on the ASX, please leave a comment, your thoughts, or a question in the comment section of this video. Otherwise, I am not a financial advisor. If you do need financial advice, make sure you seek out someone who is qualified and can speak to your own financial needs. That's it for this video. Have a good day. Bye.